When a company announces a high dividend, it sounds like great news. Who doesn't like getting paid just for holding a stock? But sometimes a high dividend isn't a reward. It's a warning sign. Behind the generous payout could lie stagnation, debt, or even financial distress. Let's unpack this properly. What dividends really mean, how they trade off with growth, and when that fat yield might actually be flashing red. Part 1. What dividends actually are. A dividend is a direct cash payment from a company to its shareholders. When a company makes a profit, management has two main options: distribute part of those profits as dividends, or retain them to reinvest in the business. If the first option is chosen, the amount, say 50 cents per share, is announced and deposited straight into investors' brokerage accounts. In markets like the U.S., dividends are typically paid quarterly, though companies often quote them as annual figures to make comparisons easier. Dividends are attractive because they offer something tangible, cash in your account, unlike paper gains that fluctuate with the market. But what about the money a company doesn't pay out? Part 2. Retained earnings, the engine of growth. The portion of profit that isn't distributed is called retained earnings. This is what fuels the company's long-term growth. It's used to pay down debt, acquire new technology or assets, fund R&D, or expand operations into new markets. Over time, this reinvestment can increase the company's value and its stock price, much more than simply paying out cash. This is why giants like Amazon, Alphabet, Google, and Berkshire Hathaway have historically paid little to no dividends. They reinvest aggressively because they believe they can generate higher returns internally than their investors could earn elsewhere, and the data supports this. A study published in the Vietnam Journal of Economics, 2014 to 2020, found that as companies mature and their growth opportunities shrink, they tend to increase dividend payouts. Younger firms, on the other hand, with high reinvestment prospects, retain more of their earnings. 1. So the real question becomes, what stage of life is the company in, and what can it do with each dollar it keeps? Part 3. The trade-off: cash now or growth later. There's a fundamental trade-off between dividends and growth. A high dividend gives you immediate cash, stable, predictable income. But it also means the company has less capital to reinvest, which could limit its future earnings. A low or zero dividend signals that management prefers to reinvest, riskier in the short term, but often more rewarding over time. Which is better depends on the investor's goals. A retiree may prefer steady dividends for income. A younger investor might prioritize capital growth through reinvestment. And of course, it depends on whether management can actually reinvest wisely. Part 4. When high dividends become a red flag. Now, here's the crucial question. When is a high dividend a danger sign instead of a reward? It comes down to one simple test. Is the company paying more than it earns? If a firm's dividend payout exceeds its earnings per share, that's unsustainable. Imagine a company earning $1 per share but paying $1.20 in dividends. That extra 20 cents has to come from somewhere, maybe cash reserves or new debt. In either case, it's not a good sign. That's like a household using a credit card to maintain a lifestyle it can't afford. Part 5. The hidden motives behind high dividends. There are 3 common reasons companies maintain unusually high dividends, and not all of them are healthy. 1. To attract investors during trouble. When a company's share price falls, its dividend yield, dividend divided by share price, automatically rises. This can make it look attractive, but often that high yield is the market's way of warning you that a dividend cut might be coming. Take energy stocks in 2020. When oil prices collapsed, dividend yields for some majors spiked above 10%. But within months, many were forced to cut payouts drastically. Recent data from Reuters, 2025, shows a similar pattern emerging again. Several oil majors, including Chevron and Shell, have been borrowing to fund shareholder returns as oil prices softened, effectively paying dividends from debt. That's a textbook red flag, rewarding shareholders today by sacrificing tomorrow's stability. 2. To mask a lack of growth opportunities. Mature companies with limited reinvestment prospects often pay high dividends. Utilities, telecoms, and consumer staples fall into this category. A 2018 to 2022 study on Indonesian mining firms found that companies with higher free cash flow and profitability tended to pay larger dividends, but only when their growth opportunities were limited. In other words, when a firm has nowhere exciting to invest, it pays out cash instead. That isn't necessarily bad, but it signals a plateau in the company's growth story. 3. To appease shareholders temporarily. Sometimes management raises dividends even when profits are declining just to keep shareholders happy or to maintain appearances. Look at Walgreens Boots Alliance. After nearly 90 years of consistent dividends, the company suspended its payout in 2024 due to cash flow pressures, litigation costs, and mounting debt. The high dividend wasn't a mark of strength, it was a symptom of denial. Or Bayer, which in 2024 slashed its dividend from €2.40 to just 11 cents per share, the legal minimum to reduce debt and preserve flexibility. Again, a high dividend masked deeper problems until the cut was unavoidable. Part 6. The academic evidence, free cash flow, leverage, and life cycle. Academic research across markets paints a consistent picture. A study on Egyptian firms, 2013 to 2016, found that free cash flow alone didn't determine dividend size. It depended on growth opportunities and leverage. Another study during the COVID-19 period found that even firms with strong cash flows and profitability reduced dividends to prioritize liquidity. The takeaway? Dividends aren't just about profits, they're about strategic flexibility. And when leverage is high, or when the economy tightens, those safe dividends can vanish overnight. Part 7. Management Trust, the Human Factor. Ultimately, dividend policy is a window into management's mindset. If you trust management to reinvest retained earnings effectively, then a low dividend can be a sign of confidence. They believe they can earn better returns internally. That's the Warren Buffett approach. Berkshire Hathaway has never paid a dividend because Buffett reinvests every dollar at returns that far exceed what shareholders could do on their own. But when management has a poor track record of reinvestment, wasting money on overpriced acquisitions or vanity projects, dividends can serve as a healthy discipline. So, the key isn't how much is paid, it's why. Part 8. What to watch for. Here are the metrics smart investors use to separate healthy dividends from dangerous ones. Payout ratio, the percentage of earnings paid as dividends. Above 80%, and especially over 100%, signals risk. Free cash flow coverage. Are dividends fully covered by free cash flow, or is the company borrowing to fund them? As research across Indonesia and Vietnam shows, cash flow, not reported earnings, is the real determinant of sustainable payouts. Earnings quality. Are profits stable or cyclical? Firms with volatile earnings shouldn't commit to high dividends. Debt levels. A company with rising debt and high payouts is mortgaging its future. Part 9. The bigger picture. So, are high dividends always bad? No, but they're not always good either. A healthy dividend policy should balance rewarding shareholders with funding future growth. When the payout fits the company's financial health, business cycle, and management philosophy, it's a good sign. But when dividends rise while earnings, free cash flow, or growth prospects fall, That's not income. That's a warning label. In investing, the best returns often come not from chasing yield, but from understanding what that yield really says about a company's future. Because sometimes a high dividend isn't a celebration, it's a cry for help.